My name is Jeremy Cross. I'm the head of finance, by which I mean banking and finance, at King & Wood Mallesons in the city. It's a firm that used to be S.J. Berwin in Europe. It's a combined firm now with Mallesons in Australia, with King & Wood in China, and various other places in between. So that's me.
Okay, good evening everyone. So my name is Ben Davey, fairly recently taken over as Chief Strategy Officer in the investment bank at Barclays. Before that, for 5 years, I was running the Financial Institutions Group at Barclays, which is an advisory and capital markets team covering banks, insurers, asset managers, specialty finance houses globally. Did a similar job on the advisory side at Rothschild for 10 years before that. Prior to that, I was a Chancery Barrister for 7 years. I know there were one or two barristers in the background. I read all your profiles before coming. And specialised in insolvency, trusts and banking law when I did that.
Good evening, everyone. I'm also called Ben. I'm Ben Hickson. I am a partner at Hogan Lovells, which, as hopefully you know, is, like Jeremy's firm, one of the biggest international law firms with offices all over the world, but pretty much 40% in the Americas, 40% Europe, and then 20% the rest of the world. My practice area is cross-border M&A, so I spend a lot of my time travelling around the world, executing transactions, and I have particular interest in the energy and infrastructure sector, which is pretty much everything that keeps the world moving and kind of keeps the lights on. So it's a pretty active and very interesting practice. I also have a role in the management of my firm, so I sit on our global management board. Last year, the firm, in a very bold and very brave engagement with the youth vote in the partnership, introduced a seat on the management board for partners who are aged 45 and under, and I am easily within that category. And so I was lucky to be voted by my fellow partners onto the board. And so since last May, I've also been quite heavily involved in some of the kind of international strategy and thinking around what we do as a big law firm.
I'm Alec Innes. You will have heard me, some of you who were here 2-3 weeks ago. For those who weren't, I'm at Lloyd's. I run our private side solutions offering directed at FIs. So basically I focus on both our own balance sheets, and I use that in the plural because we own Scottish Widows, our own pension fund and our own bank, and also for our key financial institution clients, which are very much the world that Ben from Barclays, rather than Ben from Hogan Lovells, was mentioning as his prior turf. Before that, I've been in investment banking both on the sales side and on the structuring side. I ran a structuring desk at Barcap, and before that, I was a qualified lawyer, specializing in securities law.
Great. So about a month and a half ago, we had one of our more exciting and colorful sessions of the advisory board where we debated a bunch of different questions that we might want to hear our advisory board speak about. And then you guys very helpfully helped us rank them in terms of which ones you would be most likely to find interesting. And so we're going to go through questions one by one. We're going to give every member of the advisory panel who wants to talk on a particular question the chance to do so, but you're not obligated to. And then on each question, we're going to open up for the students, and I would encourage you guys to ask all the questions that you might ever want to ask about this, because it's not too often that we get this type of grouping in one room together. So, I'm going to change the order from the questions on the slides to the order that you guys actually wanted them in. So question one is actually question 4 here. What impact is the balkanisation of financial regulation having on economic and financial globalisation? So all of this regulation that we're getting it down often not at a global level. And the backdrop of that is a larger agenda to sort of integrate the global economy. What kind of tension is that creating?
Shall I maybe kick off? And I'm conscious there are people here who are much more qualified to talk about that and effective than I am personally. I guess the main conflict here is between a sort of local de-risking and an international globalisation agenda. So actually, to take Ben's organisation to my right, I mean, Barclays is probably right in the middle of this, where you have effectively a global bank which is being asked to run itself increasingly in some ways because of the way, balkanisation is the term used, because of local regulation, because of each country or many countries trying to get the bit of the bank that is in their jurisdiction to be financially sound, to have enough capital, etc., rather than relying on the parent or the global entity. What you're getting is quite I think, a difficult balance, actually, particularly if you're in that sort of company, between trying to allow things to be global, trying to allow things to be local. So I think it's a bit of a conflict. The only thing I'd probably say that is potentially positive about it, if you were talking about globalisation, is that it does, in some ways, maybe stop countries competing with each other. I mean, the financial crisis, many things happened. One of them, I guess, was that various banks in the West were desperate for cash, so they tried to attract capital from, or suck capital out of, if you want to put it in emotive terms, out of other parts of the world. So you had capital moving very much in one direction, or money moving in one direction. So I think I will now hand over to Ben and others, because that's he will have, I'm sure, a view about this.
I have a few thoughts. Shall I have a go? Okay, so first of all, I'll have a chat. Each time we come around, I'll have a crack at sort of defining the question. And if you don't like the way we're defining the question, you can boo or whatever you feel appropriate. But it's important just to test, I think, before we start. Do we agree with the actual statement that there is a balkanisation of financial regulation? I think the short answer is yes, providing you define that as being effectively a divergence of regulatory rules between regions, and at times, in fact, not only a divergence, but an active inconsistency between the rules between regions. So I think that is, right now, a fair value statement. Two sub-questions then. What's the economic impact, and what is the financial globalisation impact? I think, in short, the first impact on financial globalisation is that those rules are slowing financial globalisation. I think that is absolutely what we're seeing right now. And in terms of the impact on the global economy, it slightly depends, I think, on which region you are sitting in, and as a result, what the regional response is, because you start to see a slowing of the globalisation of financial markets and or financial institutions. So if you start with the financial globalisation component of the question, there is no doubt that bank strategies are currently diverging. And what I mean by that is a combination of the rules that they are most subject to because of their geographic location, their pre-existing client, product and geographical set, and to a certain extent the legacy of their business and where effectively puts them as a result in its ability as an institution to meet those divergent financial requirements. By and large, what you're now seeing is the financial institutions, particularly banks, although we shouldn't rule out the impacts on insurers and pension funds, the banks retracting to core. And you see this right across the globe, banks going back to their core domestic markets as a starting point. As a general rule, narrowing down their product sets, in particular moving out of those which, for whichever regulatory regime they are most subject to, becomes the least efficient for them to allocate their capital to. You've got an absolutely huge underlying reallocation of capital within the world's largest financial institution, particularly banks. And then thirdly, a very strategic lens being applied to the client sets that as an institution you are actually able to serve effectively in the current environment. So that is, I think, a very real consequence of the balkanisation, as you're calling it, of financial regulation. There's an interesting question being much debated by the authorities globally as to what the impacts are on global liquidity. And you can bifurcate that between sort of the various asset classes, but broadly equity and debt. There is one school of thought that as you effectively slow financial globalisation, you are actually going to reduce liquidity, you're going to impair pricing, you're going to increase risk aversion. There is some evidence that that is happening. The alternative is that actually all that happens is instead of having one global market, you have large subset pools, which include over time not only in particular the banks who've been creating markets, but more substantially local non-bank players. And so I think a real underlying impact now is the rise of what you'll be familiar with in terms of shadow banking, the non-regulated part of financial markets, who, because by and large, currently are not subject to all of the regulatory rules, and in particular banks are, and in due course insurers will be under Solvency II, are able to effectively take advantage of that lighter capital requirement, lower regulatory intrusion, to effectively provide an alternative source of financial liquidity. Whether that is a good thing, you can debate. On the one hand, it clearly takes out a level of concentration risk from the banking market. Having said that, the job of banks is to remain market makers throughout the cycle. That is not the job of those in the shadow banking. Theirs is to absolutely maximise return. It's been lost, I think, unfortunately, as a result of the financial crisis, but there is a true underlying social purpose for banks, including investment banks, and they are there ultimately to maintain the stability, come what the cycle. And I'm going to be interested to see, as we roll through the next of the economic cycles, how the shadow banking players actually stand up during both the down and the upsides of the cycle. So the final observation, I think, is around economic impacts. There is, I think, as a result, friction around cross-border trade and finance. It's not developed enough as a theme yet to be able to tell you whether the market will adjust or whether it's a longer-term theme. But there has been, for sure, a reduction in capacity in what I would call the non-core developed markets. As banks, in particular, that would have otherwise set up local sovereign desks, have started trading new local sovereign instruments, decide on balance that that's not where they can allocate their capital effectively. So let's pause in.
Alec, why don't you take a forward?
Okay, I'm going to start by saying I agree wholeheartedly with what Ben has said. I think if you think about it, I'm going to give sort of three specific examples of the way that we see it affecting us in different ways, shapes and forms. Taking a very UK example, ring fencing is a classic one. Ben probably won't want to talk about that today after statements from the regulator this week about Barclays' plans. But clearly, if you think about what the regulators are trying to do in the UK, it is a step apart from anywhere else in the world. They are trying to literally set apart a retail bank from the rest of banking and insulate it absolutely in the event that the entire institution fails. That's driving a whole, stream of fraud, some of which is global and some of which is not. So if you think about new rules for bank capital that are coming in terms of TLAC for global SIBs and MWEL as they get applied to any bank or equivalent financial institution, they're applied slightly differently in different places. Again, but ultimately the idea is the same. It's different ways of trying to attack the same problem. UK, however, is going further and causing at least the big 4 or 5 banks in the UK headaches. More headaches, I suspect, for those like Barclays and HSBC, who also have to think very heavily about Volcker, about Frank. At the same time, where Lloyd's does, my institution, but we're small in the US, so it's a little bit easier for us. But you have to manage to both sets of those rules clearly if you're present in both markets. If you're going to be a large bank and serve your clients properly, you have to be in the US. It's the biggest capital market globally. Your clients want you to be there. So you begin to end up with a bunch of constraints imposed by different geographies in different ways. So that's not necessarily helping. It also, and I'll give you one very specific example of this, drives odd behaviors. So we've done a bit of a study because we think there's an opportunity of the different ways in which the LCR rules, so liquidity buffer rules for banks, have been applied globally, and there are many differences. Each regulator has its own particular take about what is a liquid asset, what can count for that half of the equation. And so what by passing different rules in different jurisdictions, what you get is, if you like, banks sitting on collateral which is more valuable to somebody else than it is to them. And so there's an obvious, if you like, regulator-created arbitrage there. That's balkanisation. There are opportunities then for banks to get together and perhaps take advantage of that. But it doesn't make for an efficient economy or an efficient means of trading if you have different prices in different jurisdictions for the same asset, simply driven because the regulator tells you it's eligible or it's not eligible, it's level 1, 2A or 2B. Different haircuts, different costs. It's not, clearly the risk is the same in that asset, but it's being made fundamentally different by different regulators in different jurisdictions. I think those are really two of the main points that I wanted to make. There was a third, but I'll talk long enough. So hand off to one of the others. Clearly, it's just not helpful, I think. And despite the verbiage at the top before I hand off, which is all, we're all aligned, we're all aiming at the same things, I think there are very clear examples for that.
I have a follow-up question actually for, we'll call him Barclays Ben.
Yeah.
For the purposes of this conversation. You talked about sort of global banks having honest conversations with the type of clients and businesses that they can meaningfully serve in this environment. Two questions, one more sensitive than the other. The first question is, who is getting shut out in this world? Are there sort of specific types of economic actors that are then finding themselves not being serviced by their traditional sources of finance and advisory work? And two, if that's the case, where they go. So what sort of new players are we seeing enter these markets, if any, to sort of absorb that business?
Okay, so that's a good question. So in terms of the who's shut out, it's interesting because the divergence so far I don't think is leaving obvious gaps of those who are now not served. And so if you just at a very high level for a minute, if you think about UBS and Credit Suisse, who have broadly said, we have a particular nexus around our wealth, private banking operations, that is helpful to sustain an equities business, that's where we're broadly going to be directing our product sets. Broadly, that means that they're out of fixed income, currency, commodities, the sort of famous macro and FIC products, broadly. Others like ourselves have real DNA around the global macro and the global DCM businesses, and as a result, so there's this migration of banks according to their legacy in different directions. You could argue, I know it's been argued in the press in the UK, that one of the areas that's been underserved has been the SME market, the small and right the way down to business banks. It's difficult to see that on the evidence, and in particular, even if it were the case theoretically, the rise of the challenger banks in the UK are a good example of where that type of business is going. And obviously, Winnings and Glyn, you have a bank that is under construction that will be very much focused around that client set. And there are a number of very successful challenger banks who have now come to the London markets and listed, whose share prices have performed extremely well and who, on the face of their balance sheet growth, are performing extremely well in front of clients as well. What is perhaps less obvious, but is I think probably the most significant change in terms of where some of this business is going, is the participation now of pension funds and insurers directly in the lending markets. And you're seeing that manifest in two ways, very interesting actually. The first is some have actually built out their own direct teams to engage with clients in the way that a bank would. It's very targeted, but they are developing their own in-house capabilities. The other way is that rather than build up a front office capability, to say, look, we're going to work in partnership with a number of the banks who, for whatever reason, are able to originate more than they necessarily want to hold on their own balance sheets. And as a result, there are various co-invest and participation structures where you can get that sort of economic exposure without necessarily having all of the front engine that you need to originate in front of clients. So I think what you're seeing at the moment in this, as far as I can tell, is the market actually operating relatively effectively. The capacity, or you could argue the overcapacity across all product sets, is beginning to ease. Banks in particular serving their core competence with where gaps emerging, challenges emerging, and at the moment, on the face of it, sort of sustaining client service as a result.
I would add to that, I think that no one is left out at the moment, or no one who should be bankable or creditworthy is left out. What I think it may be a matter of is a matter of cost. So you don't have the same breadth of choice if you need financing that you may have done in the past, whether it's from a counterparty or otherwise, and therefore you have a limited subset of people who can and will fund you in your market, and they have to pass on other costs which are imposed on them: capital costs, liquidity costs, derivative CPA costs, whatever it may be, leverage costs now being the latest one. So I think it's a function of cost rather than it being available or not available. I think there are some more macro themes, though, that I'm going to challenge them a little bit and say that certain business models, I think, are far more challenging. So I think there is a question about the viability of the truly global bank. The Citibank model, the HSBC bank model, even that's been their raison d'etre for years, are pulling out of different markets. They're being forced to. It's just not economic. And I guess there's a question about whether that global bulge bank model really works anymore. And I think the other thing is, if you think about regional differences, there's a clear discussion going on about, if you like, the Wimbledonization of London. No homegrown champions, no UK champions questioned in due course, depending on largely on Barclays these days and the route that it will take going forward. But also, if you look at the European investment banking community, whether you look at the Deutsches, whether you look at the UBSs, they are, I think, retrenched from that global investment banking model in a number of different ways, leaving really the Americans dominant in that sector with certain Asian banks as well. And that, I think, has got to be a function of the way they're being regulated. I don't know, maybe a challenge, but
I personally think it's an opportunity, but that's a second question. I think the one final afterthought is you'll only know whether there are real gaps once the credit cycle turns, because we are very much still in a hugely benign credit environment. And that's fine. It's easy for non-bank players to fill the gap. It's easy for insurers or pension funds to just gently test the water. The acid test, as I say, will be when interest rates start to move. Ultimately, will there remain sufficient liquidity in the credit markets or not as a result of some of the trends we're witnessing?
So I'm obviously not a finance lawyer, and my world is really M&A. So one thing that's really interested me over the course of the last 5 years has been the emergence of other kinds of vehicle, the pension funds, insurance companies, who are, in the way they operate, effectively they get topped up every year with more and more cash that they must deploy. And historically, if you look at the way they've deployed it by buying assets. So much of the assets in the UK are actually owned by funds, and it all spun out of a privatisation regime which happened 20, 30 years ago. So I had a question for the other Ben and Alec. When I talk to those kind of clients of mine, I do a lot of work for the fund community. They are changing their view of the world. I think they are thinking of themselves as a different kind of vehicle. And my question is really, do you see them increasing their market share, or do you see that really being interest rate dependent? Because during the very low interest rate period, they've been able to do this, but I think going forward that'll be more challenging. And if so, what happens to them? Because they've still got a lot of cash to spend.
Yeah, so I have a personal theory on this. We'll see what happens. So has there been an increase in funds participating in these types of markets? Absolutely. But I think, we'll see if this is right or not over time, I think it's very much done on almost a financial investment basis. They can see the opportunity, there's an ability to leverage their own cheaper cost of funds, there's a pool of demand there that they can meet. The banks genuinely are there to serve their clients and therefore treat it much more as a long-term relationship. And again, that's part of the reason that the banking system is there to serve all the way through the cycle, positive or negative, because they're able to, and they're designed to take longer-term decisions. And so I do wonder whether the funds see an opportunity in the current cycle, which may or may not remain when times get tougher. Whereas for the banks, as the counterexample, those underlying corporate clients or institutional clients, depending on the nature of the product, are the franchise.
Yeah, I agree with that with a couple of caveats. I think that's absolutely right, but I think if you look at the role of regulation, particularly in insurance companies at the moment, Solvency II, it is driving insurance companies, particularly life insurance cos with annuity books, which is a very big subset of these investors who are taking loans at the moment, towards that kind of investment. So what the regulation that they're all going to be, if you like, under from Jan 1 says to them is, your ideal investment should look like a corporate bond with a bullet repayment, no prepayment rights, which is investment grade and has certainty of cash flows. Now, if the less liquid the bond, or more like a loan, the actual greater the capital benefit. Book a capital benefit, the longer you go, the bigger the capital benefit potentially, and you can also book an illiquidity premium up front versus the bond if you can show that the loan price is wider than the bond. So there is a real regulatory imperative that's driving some of this behavior, which I don't think goes away. The disciplined players in that space are always looking at what they could buy in similar, if you like, credit quality within those kind of parameters. So as those market moves, they will absolutely dip in and out, for sure. That then takes you back to, well, hang on a minute, what is the right financial model? And I'm going to do a selfless plug for Lloyd's here, because we're the only proper bank assurer in this country. And that gives us the flexibility to have that balance sheet on one side, subject to all the right governance and being independently run, plus a bank on the other side. So we have both bits of the engine. HSBC has a very small insurer left. None of the other banks do in the UK. So it's quite interesting. I wonder from an M&A perspective almost, whether that will drive some of our competitors to hook up more closely than independent, little partnerships on the side. RBS announced one with M&G for mid-market lending recently, last week or so. Those sort of informal arrangements. I wonder if there's more formality to those to come, being driven by, if you like, this market behavior.
I was going to actually raise that or ask that same question from the two bankers, as it were, here, because what I see is more of the fund insurers, not so much insurers, the pension funds or the funds, beginning to tie up with or be taken on by some of the banks. I see that happening a little bit with, and there being sort of JV arrangements and things like this, and I see that, and obviously it's happened with Barclays and it's happened with others. I sort of see that happening, and I'm probably backing up Barclays, Ben's point here a bit, that I see, slightly different point. I see some of these funds which are currently operating very independently, and as you say, currently operating as, lenders of opportunity. I see some of them being brought perhaps back into what I call the more regular banking system in some way, and I see you can sort of see that happening a little bit now. I'm quite sure it will happen a lot more in the credit cycle terms, either one way or the other. So.
This all sounds like very good news for French banks.
Canadian banks too. There you go, Dan.
As the representative of yes. Okay, any questions from the students on this issue of balkanization versus globalization?
So,
and I should say as well, everybody should speak up because there's a nice man with a camera back there.
So Professor Roberta from the Yale Law School, she has a theory that financial regulation there should be more diversity in financial regulation because with more experimentation, so taking into consideration that we have emerging markets with different financial infrastructure, balkanization might be a better idea as opposed to harmonization of global regulation. So I was wondering.
Yeah, that's an interesting theory. So in theory, that could be right. Okay, so you say, look, if you just have a big homogeneous financial environment, you end up with a homogeneous financial system, and that it stops innovation, and so theoretically that's right. So, but there is a big but here. When we're talking about balkanization, I'll give you the perfect example of this because it's real time. It comes back to Alexander's example of ring fencing. In the UK and in Europe, there is a general policy theme which is consistent, that the regulators rightly want to protect the retail part of the banking system. And they define that broadly in the same way. It's the retail customer and the small end of business banking. In the UK, they came up with the answer, which is the right way to do that was to put a ring fence around exactly that universe of customer, the scope to increase it, but there's a core, which is the small retail customer and the small business customer. In Europe, under the Liikanen report, as originally drafted, same objective, but the best way to do that is to put a ring fence around the trading operation of your bank. So exactly the same outcome intended, completely the polar apart as to how one achieves it. And really that's where I think you get a real problem with inconsistency. Because you can't, as an institution, or it's very difficult as an institution, to navigate clearly the polar ends of the potential answer. So I think the answer sort of sits somewhere ultimately between the two, which is where there is a commonly identified greater good objective, it really should be the case that globally we come up with the right answer to achieve it. What you want to avoid is exactly, I think, what the professor was talking about, is that you take that to such an extreme that you end up with a monoline financial system which doesn't allow innovation and creativity. But I do think the two here are very different.
I guess I would add to that as well. In Alex's example, there's something like global inconsistency in liquidity coverage ratio, collateral buckets, and it leads to a more heterogeneous world, but it leads to a world where that heterogeneity is exploited by institutions in multiple jurisdictions. So you get a Canadian bank and a European bank entering into transactions with one another, long-term transactions, designed to exchange that collateral. And when there's problems now in, let's say, the Canadian system, and we wake up one morning and find that then European banks seem to have suffered as a result of things that are happening in Canada, did that heterogeneity really insulate the sick patient, or did it mean that ultimately sick patients were much more connected with healthy ones? Other questions?
Hello, thank you for the presentation. My question was essentially that most of your presentation covered, let's say, the situation in the US and the EU, for that matter. My question is, if we go more towards the east, let's say countries like China and India, which in a lot of ways there is this perception that in the coming future a lot of the rules as such would be, let's say, shaped by how things are going to change in the east. Therefore, from your perspective and from your experience, how have you seen this balkanization working, let's say, more towards the east rather than US and the EU?
Yeah, very interesting. So I did a lot of work in the financial crisis for various sovereigns globally. And actually, one of the things that I did was spend some time in Scandinavia learning about how they addressed the previous financial crisis and also in Asia. And I have to say, the answers that have been developed in both parts of the world were incredibly valuable and ultimately deployed back into Europe and into the US. So I think the answer on balkanisation in that context is quite interesting, because obviously in that part of the world, I spent a fair amount of time in Japan. There is a real focus on diversifying out of the local market and diversifying globally. And so almost the reverse, I think you're observing in a number of the Asian markets, which is a recognition that a lot of good work was done in the past Asian financial crisis to effectively create relatively strong, if not extremely strong, financial institutions, depending which one we're more specifically. I think there's a recognition that the Asian markets traditionally have not been as diversified, and an opportunity has presented itself with the relative weakness in Europe, but also the US since 2008, to actively diversify both the asset base of their pension funds and their insurers, and to encourage their banks, in a much more managed way than perhaps has happened in the past, to expand internationally their customer-facing organisations. And they've done it so far, I think, extremely effectively. So it's a little bit like we were talking about earlier, whilst it is, I think, in many ways a constraint for the US and European, and therefore your question is extremely on point, it's a huge opportunity for a number of those banks from India, China, Japan, Singapore, Australasia generally, to effectively diversify their models in a very capital and cost-effective way for the time being.
I think maybe just to add from a personal anecdote on this, when we were doing our negotiations about merging as a bigger firm and going to China, and we flew to Beijing, and I was a finance lawyer who had been through the financial crisis, was fairly imbued with the ring fencing and all the de-risking, in effect, if you call it that, the European and US banking system. And when I went to China, I was extremely struck by meeting my counterpart there, who was talking about what the Chinese banks were doing. And exactly what Barclays Ben has been saying, that was exactly the thing. They were busy pumping money into overseas, basically, into Europe, into Africa, everywhere, South America, everywhere. It really was an entirely different approach, completely. And it struck me from my rather insular UK European level as quite astonishing, actually, the difference in approach that was being taken, and I think still is being taken to a certain extent. I mean, I know the Chinese have had their minor shocks and everything, but there's still a very different mindset, I think, around in the East, put it that way, certainly in China, than there is in Europe and probably in the US at the moment.
Mindset or application of regulation to drive that mindset?
That's a good question.
Bit both.
I think it's a bit of both. So we did a study of our competitive position versus, Ben seen one of the slides of this, I think when I was here a little while ago, I put up the sort of index slide of 26 or 27 different regulations that impact on us in absolute terms, and then versus regional competitors, whether that was European, US, Asian. And almost without fail, we were relatively impacted versus Asia. Versus different parts of Asia as well, in different degrees, but they are, if you like, less capital intensive, less regulated, more able, therefore, to deploy at profitable levels, and therefore it makes sense that they're going to be doing that. It may also ultimately beg the question of, if we're now supposed to be safe the way we're run, and they're taking greater risks, what does that mean for 5-10 years' time? What does that mean when the Chinese economy in particular maybe starts to struggle a bit more? People are quite worried about that at the moment, and I think about some of the Chinese banks in particular. So there's pluses and minuses to that situation.
Yeah, I agree. I think the regulation is much lighter in that part of the world. I mean, that's not without the benefit of study.
The Wild East?
Potentially over description. I don't think it's as wild as people think it is, but I think it is certainly less regulated.
But again, you've got to be very careful. So every market is very different.
I agree.
So I won't call out individual regimes, but there are vastly different approaches to regulation on a country basis. But I mean, I don't know if you saw it. There was the FSB to talk about the application of the TLAC rules into China as being one example. The timeframes for that are relatively protracted, shall we say. So there are definitely differences right now in terms of, as you'd expect, in terms of the speed at which the newer regulations are going to be implemented globally.
Do you think HSBC is going to hop to Hong Kong and take advantage of that?
There are many considerations, which I suspect they're having.
Any other questions on this? Yeah.
We've seen like some minor disruptions on the New York Stock Exchange and the London Stock Exchange this year due to algorithmic trading. So what's going to be the future of that? Like is there any regulations that you're going to see that stops it, or like are they just going to replace the flow trading?
That's a good question. I'm not sure, actually, is the answer at the moment. I think there's a lot of work being done to dig deeper into algorithmic trading, to really understand how the algorithms work in practice. I think to understand truly whether there is any propensity or risk of market distortions as a result. And I'm just not sure what the ultimate findings are going to be on that. It is a hugely important part of the market. And obviously, I'm sure you've read all the studies about the extent to which you have aligned algorithms, or you end up as a result making the spikes higher and the trans lower. So look, I don't know. It's a really interesting question. We should definitely, as the studies come out and the regulators start to opine, I'm certainly going to be reading it very carefully. There is a theory out there, I'm not sure it's right, there's a theory out there that all of the high volume and algorithmic enhances and increases liquidity. I think the challenge to that theory is it simply just intermediation on the way through to end buyer and sort of end starting seller, as it were. And therefore, all you're doing is you're increasing the intermediation on the way through, as opposed to genuinely actually increasing liquidity. And I think it's going to be fascinating to see what the study is producing. So ask me that question in a year, and hopefully I'll give you a fuller answer.
Yeah, we've got a commitment to come back in 1 year.
Following on the theme that there's lighter regulation in China, do you think the concern should be the balkanisation of financial regulation or the quantum of financial regulation?
Good question. Both is the answer. Balkanisation, previous answer stands. The quantum is quite off the charts, and it does depend which which institution you are. We have the fortune of being required to study quite a lot of it, and it's a mapping exercise. It's then a consistency exercise. It's then a timing exercise. It is an understanding of your products, your systems, your data, your clients, and the prioritization that you then have to apply to each of that lens to each of your regulatory requirements. And then you have to figure out your lowest cost solution to meet all of those sometimes inconsistent requirements within the timeframes that the multitude of the different regulations require. So it's quite a task. The good news is, courses like this are supplying lots of very bright people to help us, which is great. And so I think I'm being asked a little bit later to comment on the course, and I can just tell you are absolutely in the sweet spot of, I think, a huge demand for talent. I won't do a pitch until later, but the quality of the financial and legal thought that is now required to answer your question is, I think, of a scale that we've not had for absolutely years. And obviously, individual disciplines will obviously pick up their key parts. The ability that you have from this course in bringing both a legal and a financial brain to it, I think you're going to find puts you in great shape. But to be honest, the volume piece we shouldn't underestimate. I think you're quite right. What would be great is if someone sat down with the world's logbook of current regulations, worked out where there was duplication, and slimmed it all down into one sort of neat pack. We're effectively having to do that in our own individual houses, insofar as it applies to ourselves. But it's quite an inefficient process.
The only glimmer of hope on that particular horizon, to sort of finish that thought, is that I think if you listen to senior members of the FSB or the Basel Committee, or et cetera, they're starting to say, well, we think the big jigsaw pieces are done. We're watching them through implementation now, and it's time to start thinking about calibration. When I asked the equivalent people at the British Bankers Conference a question, not this year, last year, we had a Deputy Secretary of State for the Treasury and Ben Blomberg from the Bank of England, whether they thought they'd gone too far, whether there was too much overlapping, how they were going to calibrate it. The mood music at that point was, no, of course not, don't be silly, we're still making the system safe. This year, without being prompted, Ben Broadbent stood up and said, yeah, there's a calibration process to happen now. So they are at that level realizing that, okay, I've made it safe, now I need to make it work. And so it's going to be interesting to see how that progresses over the next little while.
I think that's just on that point. There's a temptation to go too extreme around the way that the press write is up. There is now, I think, a lot of very constructive dialogue ongoing. Academic contributions, industry forums. So I think a recognition that there was at least a question as to whether or not there's a serious calibration challenge is now, I think, openly accepted, and there's a much deeper debate now about how far we need to move.